Good morning, welcome back to another stream. So I began this topic last week, but unfortunately my internet cut out in the middle. So this is a continuation from my last video where I looked at an introduction to investing, and then we touched on what halal investing is. So in today's video, we're going to be continuing discussing some basic concepts when it comes to investing. When it comes to halal investing, we'll be looking at some halal investing funds in Australia and overseas, or in particular in America. And then finally, a very important part of investing, we're going to start to look at what is an investment portfolio and how to manage your assets based on your personality and your risk tolerance. So big disclaimer before I dive in. I am not a financial advisor or planner, so don't take anything that I say as financial advice. Like, always talk to financial experts and advisors before making any, big changes or actions when it comes to your hard-earned money. So take this as just a bit of entertainment, edutainment, as they say. A little bit about my background. So I love maths. One of my majors is pure mathematics, and I've just loved learning about finance and money and business as well, probably for almost 2 decades, like quite a while. I've done a course in financial planning, so I'm going to be sharing some of those things that I've learned from that. But also, I would say my superpower is actually teaching, because I have a background in education. So that's my aim with this video is, I guess when you learn from financial experts, they often speak a language that sounds like Chinese to you, and finance is quite a heavy topic that goes over a lot of people's heads. So my goal is to break down these more complex concepts into just layman's terms. So if you look up definitions, it'll be much more complex out there, but the way I'm trying to explain it is so you'll be more informed. So when you do talk to a financial advisor or a planner, you'll feel a little bit more confident, and you will be asking more, I guess, informed questions so that you aren't taken for a ride, because unfortunately there are a lot of scammers in this industry. So yeah, at the very least, I hope you just feel a bit more empowered financially when it comes to this knowledge. But yeah, so if I achieve that, I'm hugely thankful. So let us dive in. So I'm going to share my screen. So we'll do a quick recap of what I discussed in the previous video, and there's a link in the description to that video if you missed it. Okay, so in the previous video, we touched on some very basic concepts like what is investing, what is an asset, why do people invest? We talked about some definitions like what's inflation as one of the reasons why people invest. And then we looked at an example of how investing helps beat the effect of money, losing its power ultimately over time. We talked about some basic concepts that you'll hear in the world of investing, like what a share or stock is, what's a dividend, what are REITs, which is also an ETF. So what are ETFs? So I will be making references to this. So probably one thing I will reiterate is what ETF is, because we'll be discussing some halal ETFs in this video. So ETFs are essentially funds that are traded in exchanges like, the Australian stock market, the US stock market, but they're great in that they're different to an individual share and are often a pool of shares. So for example, there might be a technological ETF. So it will be a pool of all the technology companies like Apple, etc. So it's different to investing in just one company, Apple on its own, which does pose a little bit more risk. So we'll be looking at that a little bit later. So we also discussed what halal investing is. So I have the link to that as well in the description. So again, I'll do a quick recap. So I'll just share this screen again. So just key things we talked about is halal investing is basically normal investing, but it eliminates certain companies that don't align with Islamic values or have in some sort of aspect that relates to interest, which is something that Muslims try to avoid, but also companies that have very high debt, which is another aspect when it comes to, I guess, Islamic principles with investing. It's to reduce risk so that you're not putting yourself in a position where you have a higher chance of losing your money. But yeah, so that's just a very quick intro and recap of what we discussed last time. So let's now talk about, I'm just going to get my notes. So we've touched on just a broad intro to the concept of investing and then what halal investing itself is. So the next stage is something that's very crucial when it comes to investing, that I would say people who dabble in investing miss, and it is to manage your risk. So there is a concept called working out what your risk profile is, and then that relates to managing your risk when it comes to investing. So let's talk about what a risk profile is. So essentially, a risk profile is typically a questionnaire that you can complete to help you work out what is your comfort level when it comes to the ups and downs that investing involves. So if you go and see a financial planner, they'll often get you to complete a risk profile questionnaire, and then that helps them understand, firstly, what stage of life you're at. So for example, if you're quite young, you've just started work, you might be more comfortable to invest in more risky assets. Whereas if you're older, you're retiring soon, your needs are very different, and you probably don't want your money to suddenly be 50% down because you need that money, in the next year or so. So what we're going to do is we're actually going to look at an example of a risk profile questionnaire together. And this is something that is linked in the description, so you can do this for yourself. And then we're going to learn some concepts when it comes to working out what your profile should be. So let's have a look. And I'll just share my screen. There we go. So this is just a basic risk profile questionnaire. So it gives you an idea about the kinds of questions that a financial planner will ask you that helps them then make some recommendations to meet your needs. So firstly, question one, most people can access their super. So for people who are in other places around the world, super is a retirement fund. So that's just what we call retirement funds in Australia, superannuation. Australians like to abbreviate a lot. So it's asking your retirement fund or your super is typically accessed from age 60 and has a 50% chance of living, and people have a 50% chance of living to the age of 91. So over this period, will you use your retirement savings? So are you planning to take it all out and spend most of it? So let's say you're ready to retire, you work so hard your whole life, and you just want to cash all of it, go on a world trip, and just enjoy it. So then you would tick this one. Spend most within 5 years of it becoming available, spend most within 10 years of it becoming available, or draw it evenly throughout retirement. So let's say you're a little bit more cautious, you don't have a lot maybe, and so you want to use it a little bit more frugally, you want to take out from it bit by bit, or do you actually want to just be really generous with it and you want to take a little bit, but you want to spend most of it, as a bequest. So let's say I plan to draw out evenly throughout my retirement. So I don't think I'm going to have tens of millions of dollars because of the kinds of work that I've done over the years or am doing. So I might just go with this one. Or actually, even if I have a lot of them out, that's another reason why you might take it out more evenly. So next question, generally speaking and considering the proposed term of your investment, which of the following statements best summarizes your objective? So this is now asking you to think about how long are you planning to stay in that investing game? So are you quite young and you have decades ahead of you, or are you only just getting into investing and you're going to retire in the next 5 years? So if you think about that period, we now want to know, what is the thing you care about most? Is it certainty of returns, meaning you would rather invest in something very stable that you know may not make tons of money like crypto, but you would rather that it makes a small amount consistently and it's proven for decades, because it's literally like, you know, like a fish and chip shop, for example. Not that that would be on the stock market, typically, I don't think, but you get the idea, the concept. So then that's what you would tick. Or do you prefer predictable returns, but you're okay with some fluctuations when it comes to investment because you want your investment to grow faster? So what this means is you still prefer more stable companies, but you don't mind there being some years where the company is not doing so well because, you know, the season has changed. So an example would be, say, the mining industry. So there's certain periods where it's booming and then other periods where it goes down. But it's a company that you think is going to stay around for a while because it's been there forever. So that's a bit more, I guess, actually, a mining company probably is not a good example of something predictable. Predictable probably would be like a grocery store. It's something everyone needs, but still it'll go through its ups and downs because maybe there's some bad news or there's like a drought and it affects the farmers and so forth. So that's probably a better example. But yeah, you want predictable just returns, but you don't mind some up and down with the value. Or do you want a balance of stability and growth? So you're more sort of in the middle. You don't want too much like just stable because it means you're not going to grow as much or quickly. So that's where you choose this. Or overall investment growth is more important than stability. So let's say if I'm fairly young, I would probably pick this because I'm not going to be accessing this money for decades. So I don't care if it goes up and down. I'm not even looking at it. I would rather take a little bit more risk in a company that might just go crazy well, even though it might go through those ups and downs. But then there might be someone who's a real investment cowboy, and they might say, you know what, my priority is higher returns, even if they fluctuate significantly. So then an investment or financial advisor might even suggest they invest a little bit in crypto, which is has a very high, growth, but extremely volatile. Like you have to look at it way, way often. So I'm just going to go with number 4, option 4. So question 3. How prepared are you to accept investment returns that vary each year? So some of these questions are a repetition, but asking you in a different way just to really drive the point home. Because when you think about it theoretically and you're like, oh yeah, I want higher returns, I don't mind it going up and down. But when you physically see it, when you see $1,000 is now suddenly only worth $600, like it's like, they say people who are investing and like look at their investments frequently, they have to have a very strong gut, literally. So that's why they're asking these questions again, just to drive that point home. Like, are you absolutely sure? So otherwise you're going to be calling your financial planner and be like, what's going on? I'm really angry at you, etc., etc. So let's say, so what's my answer? So do I accept, so how prepared are you to accept investment returns that vary, that go up and down each year? Not at all. I want it steady. It's more important than high returns. So I don't care if it's a small amount that's increased, as long as it's not like up, down, like a zigzag. I'm okay with a small variation in investment return from year to year. To some extent, I could accept up to 3 negative returns in 20 years. So this is really important. It's really driving home how specific you have to think about it. So if you're thinking in 3 years, in over a 20-year period, there might be 3 years where your money's like half the value of what you put. But if you stick it out and you think long term, it'll come back around, assuming that these are reputable companies that you've invested in. I can accept variations as I'm a long-term investor, or I don't mind volatility. It opens up more opportunities to maximize long-term returns. So again, if you're a cowboy, it'll be this one. But I think I'm going to go with this one. I can accept variations because I'm thinking of this long term. I'm in my 20s, for example, or even 30s. I don't plan to touch this for at least a couple of decades. So next, how concerned would you be if your investment fell by 20% over a 3-month period? So again, same concept, driving the point home, but being more specific of what you may have to accept seeing. So what does this mean? I've put in $1,000, and in 3 months, my $1,000 is now only worth $800. How comfortable am I seeing that? So will I be panicked and I'm like, oh my God, I need to sell it immediately, keep what I have left? Or am I going to be concerned? I'd move some of the money to cash, which obviously has no up or down at all. It's just that stable. Somewhat concerned, I'd monitor the situation and think about a switch. Or not concerned at all, it's a long-term investment, I've seen it go back up. Or no worries, in fact, I'd think about putting even more money in. So this is people who are not in a long-term investors, but are traders. So in other words, like stock market traders or share traders. So when a company goes down, when the value of a share or a company goes down, but they know that this is a valuable company because they've done the research, they've read about the company, they know who the CEO and the board or of directors are, etc. So the way they see a company's value being less is, this company is on sale. I'm going to buy even more because it means I'm going to make even more money in the long term. So this is actually Warren Buffett, who's a really famous American investor. That is actually how he describes his approach to investing. Is he really does his research about the company and ensures it's a stable company in terms of how it runs. It has long-term prospects or value, etc. It's not just something like, for example, the textile industry has really suffered because a lot of people just buy, material from China rather than locally because they can get it a lot cheaper. So in fact, there's a quote that I really love of him, which is something along the lines of, be greedy when others are fearful, and be fearful when others are greedy. So I think a great way to explain this is looking at investing in property, because you probably will have even friends that you can think of who've experienced this. But the way Warren Buffett invests is he would be looking at the prices and looking at everyone. And if everyone's like, oh my God, the property market's really booming, and then everyone's buying, everyone's excited about buying, and that's when you buy, and then you see the market sort of dips and you're like, oh my God, I bought too high. So that's an example of being greedy when everyone else is greedy. Whereas Warren is like, I'm going to wait. Everyone's buying right now, so it's definitely not a good time to buy. It's the market is overpriced, but I'm going to wait till the market goes back down. I'm not going to buy when it's really, I'm going to wait till there's signs of it becoming a bit better. And that's when I'm going to buy. And that way I maximize what I potentially can make. So that's like the people who the property market is down, so they don't buy property immediately when it's down. Some people will, because they don't mind just sitting with that investment for some time before it picks back up. But then it's actually a property investment strategy that I learned, where you look for signs that an area is going to start to turn around. So for example, the government is starting to invest in the area. They're going to be building, schools there, or like a, leisure center, etc. So it suggests, oh, this area might start to pick up if there's been a really bad property, crisis, and that's the area you want to buy. So that's sort of that concept of what this means. I don't care. In fact, put more money in. But I'm just going to go with this one. I'm not too concerned because I'm just thinking of it long term. So yeah, last question is, how important is it to you that your investments keep pace with inflation? So in my last video, I talked about how often people recommend investing because it helps you beat inflation, in the sense of it's a way that you can keep your money power or money spending power in spite of inflation. So again, just asking you, how much do you care about that? That, $100 will still be able to buy $100 worth of stuff in a few years' time versus what you can today. So let's say, again, you're planning to retire soon, so you don't really care. You were keeping money under a mattress, so not a big deal. 2, slightly important, just keeping pace with inflation is fine. Or fairly important, I know that I'll need to take some risk to ensure my returns beat inflation. So again, it's sort of driving home that concept that the higher the risk, there sometimes is a higher reward. Not always, but there is sometimes. And that's why people will take that risk. Or lastly, extremely important, the priority for my retirement savings is to grow significantly above inflation. So I want to be able to use this money for the rest of my life after I retire, and I want the maximum amount possible so that, it's got that spending power. So I'm going to go with the 4th option, and let's see what my risk profile is. And here we are. So it's telling me, in terms of the, description of me, I'm a confident investor. So based on your responses, appears you're a confident investor. You're optimistic when it comes to risk, quite willing to trade off security for higher returns. And then it breaks up how to spend your money when it comes to investing to meet this profile. So, which brings us to the idea of growth assets versus defensive assets. And then there are things that are classed as sort of in between. So growth assets, so probably jump back and we can write some notes. And then actually, let's do it. And then we'll come back here. Let's go back to here to write some notes. So firstly, what is risk profile? Essentially, it is your comfort level. Comfort level when it comes to risk, which we just discussed. So then the first thing is, what is a growth asset? So we've already discussed assets in the previous video, so just I recommend going back to that. But essentially, it is something that typically will grow in value over time, often is income producing, but at the very least, there's an expectation that it will grow in value over time. So we talked about how that's not necessarily like a car. Some people consider an asset, but really it's not, because in the world of investing, because once you buy a new car and you sell it in a couple of years, are you going to get more than what you paid for? Nope, unless maybe it's a vintage car or like a rare collectible. So growth asset is typically shares in companies. So then I just put in like, maybe what a return is. So 10% honestly is considered a really good return, but then you might be lucky to get even higher returns. So just to understand, what does it mean by a 10% return or a 20% return? So it means, a 10% return on $100. So say in a year, so if it's like annual return, in a year, you can expect your $100 should now be $110 if it's a 10% return. If it's 20%, in a year, $100 should now be $120. So it's growing. And this is considered really high because I guess if you compare it to interest, what is an interest return? Like 2%, 1%. That means in 1 year, you can expect $100 is now only $102, for example. Another thing that typically is classed as a growth asset is property. Return won't be as high as companies because companies are for profit. But I just, made up a figure just to give you a sense of what I mean when it comes to risk and potential return. So risk versus return. So property, so let's say 8%, and then another example of a growth asset is crypto, which might literally give you 100% return. So what does that mean? I put in $100, it could literally become $200 in a year. It could be even more than that. But what is the catch? There's always a catch. The catch with growth assets is they come with more risk. So as I mentioned, and as we discussed in that website, looking at the risk profile questionnaire, there might be some years where you look at your portfolio and you're like, what? It's like, down, it's, minus, not minus, but it's way less, like it's down by 30%, it's down by 50%, which is really bad, but that has happened in history. So that is something to think about, is higher return involves higher risk. So this will be down, up and down, up and down, up and down, something like crypto compared to a more stable company or share. So that's growth assets. So the next type of asset is a defensive asset. So a defensive asset is typically referring to bonds, and then I've put in cash because technically cash is not an asset because it's not growing. In fact, it's losing value over time because of inflation. But I guess for Muslims who don't have access to halal bonds, then they might just, keep some money just as cash to balance their portfolio. So let's now go back to that questionnaire results. So we're now looking at, growth assets, what percent it recommends compared to defensive assets, what percentage it recommends. And then it's got defensive growth. So sometimes property is put in this category because it's not as risky as a company, but it's not as volatile. It's not as stable as a bond. So I'm not going to go into bonds in too much depth, but I'll just give you an example of a bond. So an example of a bond is a government bond. So what that means is basically you are lending our government your money, and then because the government needs money for improving roads, for its government workers and whatever, for projects and initiatives and policies, and doesn't get all the money, doesn't get enough money from taxes, believe it or not. So you can actually buy government bonds where essentially it's like they're lending you money, and then you get a return for lending you that money. And so there's, bonds or can be a corporate bond, which is more relating to a company, but that just gives you a concept of what a bond is. Essentially, it's a way of making money, but it's not really a company. It's really almost like a loan, but you're rewarded for giving that loan, and it's considered way more stable, especially something like a government bond, because you're like, well, hopefully, I mean, at least in Australia, the government's probably going to be around, for many, many centuries to come. So I shouldn't have to worry about the government ripping me off and not paying me back my money. Whereas a company, I don't know, they have great ideas, but maybe they're wrong, and maybe they will, shut down and my money's gone, or if I can't take it out in time. So that kind of gives you an idea about what a bond is. So because bonds are like a loan and often involve interest, Muslims generally will avoid bonds. However, there are now halal bonds. So again, I'm not going to go into the complexities of how that works, but obviously they're usually connected to Muslim majority countries. So it'll be Muslim majority countries that will be offering them, but we will be talking about how you can tap into these when we look at some halal investment funds. Okay, so that now brings us to the idea of asset management, which relates to what we've discussed just now, which is your risk profile. So just jump back to this. Okay. So what is asset management? Essentially, it is how you split your money into different investments through your buying and selling decisions. So according to my, so I'm just going to put the example that we had earlier. So according to that website, my calculator, so it's saying growth assets, I should put 60% towards growth assets, and then I should put the remaining, I'm just going to simplify, I'm just going to go growth versus defensive, and I should put 40% into defensive assets. So what that means is my asset management, I'm going to, so $1,000, $600 is going to be spent on things like property and companies, or, stocks and shares. And then 40%, I either just keep in cash, so technically that's not going to grow, or if I have access to it, as a Muslim, I would put that into halal bonds. So that is I would say on the more conservative side of an investor. Whereas another example of a risk profile of like a cowboy, it might be 80% growth and then only 10% defensive, just to give you a bit of an idea. Or people will be like, you know what, I might just put all of it in there. Probably financial planner wouldn't recommend that, because the idea with the defensive assets is when the stock market is down, you are not stuffed, basically, without finding a better word to describe it. So that's what asset management is. So then what is the purpose of asset management? Ultimately, it is to reduce your risk, because I guess a lot of people who dabble in investing and they don't know too much about investing is they just put all their eggs in one basket. So for example, they really love the company Apple. They're a huge, Apple, buyer. They believe it will last forever. So they are like, you know what, any savings I have, I'm going to chuck it in Apple. The problem with that is, as history has shown, is there are times when the market has changed, like maybe, God forbid for Apple employees and so forth, but let's say, a challenge happens with China where, a lot of Apple products are made, and Apple can no longer access China's resources, and what's going to happen to Apple. You just don't know what the future holds. So the whole idea with breaking up your money into more places means if one thing is down, you can at least have a bit of comfort in knowing something else is up. So if technology is suffering because there's really bad news about technology and everyone's now scared, but then maybe the kind of property area is really strong, so then you might put more in property. Or correction, when you've balanced your portfolio, splitting it up into these different areas, you don't even have to do much, except actually that's a whole other topic. We'll talk. Rebalancing is something, but that will be for another video. Don't want to overwhelm you. But if one thing's down, you don't have to stress as much because something else has picked up the slack because it is up. So that is what asset management is. So I actually have made a spreadsheet. So I'll probably share this in another video, like what my spreadsheet looks like. So if you can make one of yourself, but you can, I'll make it available on my website so you can purchase it if you just want something that's just done. So it helps you, I guess, do this of, work out what do you have currently asset wise. So how are you currently, how is your wealth currently split? And is it too risky in one thing? So for example, maybe a lot of people might be highly in property, because especially as a Muslim, there's not, if you don't know too much about companies, you don't know much about, the financial market, you definitely don't want to just chuck your money in, especially if there might be things that don't align with your values. So yeah, so let's now go into the how. So I'll share a website that I personally use, and I'll explain why I personally use this particular website when it comes to investing. So this is for Australians, but I will be looking at, I guess, some examples of halal investing funds that you can access from overseas as well, or in particular America. I think there's some that might be opening up to other areas. But once you've got this concept of reducing your risk by spreading your money across different types of assets, then you don't have to use my examples. You can go off on your own and research your own. It's because you have that foundation now. Okay, so let's look at this platform. So I don't know if you've heard about this particular company, but it is a fintech company, financial technological company called Stake. So I actually discovered Stake a very long time ago, over a decade ago, 15 years ago, a long time ago. And Australians are lucky because they have added the Australian stock market, but back in the days, Stake was a way you could invest in the US stock market, but the fees were crazy cheaper. So if you, the most popular investing platform in Australia, I think that's been around for quite a while because as I mentioned, I've kind of been looking at investing for probably nearly 2 decades, is CommSec, which is kind of attached to the Commonwealth Bank of Australia. But just to give you an idea, although CommSec gave you access to buying US shares, so let's say I want to buy a share in Apple, the cost of buying however many shares, but the cost of one trade, so that's one buy transaction or one sell transaction, at the time was like $100. So for the everyday user, you're like, that's, if all I can afford is like $500, that's like 20% of my money. It's just not even worth it. So I discovered Stake because you were able to invest in the US market at the time, literally with no fees, because they'd work out this technological way of linking up and reducing their costs, etc. And so that's how I actually, got into them. And then more recently, they have added the Australian stock market, and they allow you to roll over your money into Stake from an existing fund for superannuation. Actually, that's a little bit, no, sorry, correction. They don't offer superannuation, but you can roll over your existing investments from, for example, ComSec to stake. The superannuation, again, is a whole other topic that I'll leave for now. So why do I like stake? I like stake because it's extremely low fees. So for the Australian stock market, one trade currently is only $3, whereas I think most other places, the minimum cost of just one trade would be typically 10, 20 bucks at least. And two, you can access both the Australian stock market and the US. So there is a catch with the US stock market. This is how they make a little bit more money. So I'm just being very transparent with you. But they charge obviously like an exchange rate fee. So when you change your Australian dollars to US, you will quote unquote lose a little bit of money in fees. So, but yeah, that's just like another way you can sort of make money. So now it brings us to the question of, would you put money in just one or just the other or both? So this comes back to that whole idea of managing your risk. So as an Australian, I live in Australia, so Australian shares are considered less risky because I'm hearing about the companies in the news. I'm able to access Australian newspapers and so forth really easily, whereas US don't know too much about it except what trickles across to our news. So that's where it's considered more risky. But obviously there's really great companies that have been around for super duper long. So it may be worthwhile to put money in the US, but depending on how you feel about risk, when you do the questionnaire and just honestly, just sort of asking yourself, and obviously financial advisor, they'll do this for you, but essentially you'll make that decision of how much you might put here versus here, firstly, just as a general percent. But also within these like markets, you'll have to make decision of what to invest in itself, which is connected to different types of risk. So this will make more sense when we actually look at some examples of halal funds. But yeah, so this is one way to invest. However, especially when I share some halal funds, you get the idea of that, you can invest with some of them directly if you meet the requirements of they service your country, because some investments, because of laws when it comes to compliance and regulations, they won't allow just anyone to invest. You have to meet certain sort of criteria. So that's personally why I like stake. So just to give you an example of like why I decided on stake over other ways is you may find some halal funds where you have the opportunity to invest directly, but the minimum amount that you have to invest is typically quite a lot because it's a lot of admin for them, etc. So for example, the minimum amount might be $5,000 before you can even make an investment in them. Whereas with stake, you can invest with as little as 500 Australian dollars. At least through the ASX stock market. I think Wall Street, there might actually be even more flexibility from memory. I'm a long-term investor, so I don't kind of constantly buy and sell, so I have to remind myself at that. So let's now look at an example of the halal funds that I mentioned. So we're starting with Australia, but I will talk about like another one that is based elsewhere. So in Australia, there is a company called Hejaz. It's not the only one, but the only reason why I highlight this one is because this is available through stake, and I believe it's available through the Australian stock market. So Hejaz, here we go, halal ETFs. So it's not, Hejaz offers the first Sukuk ETF. So what is Sukuk? That is essentially halal bonds. I talked about, defensive assets that are more stable. So Hejaz is currently the first. I don't know if it's necessarily the only one, but it's the first to offer it on the Australian stock market, and you can get it through the platform Stake. But it also offers some other ETFs. So they include, actually, let's just have a look at the overview. They might give you a summary of all of them. Yeah, they do, perfect. And so if you have access to the ASX, you can just invest that way. But as mentioned, I choose Stake because it only cost me $3 to buy or sell. So first one that they've listed is ISLM, obviously of Islam. So hijab aims to deliver positive impacts that marries with financial ambitions while integrating moral values. Okay, it doesn't really tell me what that is. Let's go into it a little bit more. I feel like I should go to where are we? Okay, it's equities. I was wondering, what is Islam? It's equities, so stocks. So this is an example of a halal ETF, so exchange traded fund, which has filtered out the stocks that don't align with Islamic values based on those criteria that I briefly touched on and I discussed in more detail in my previous video. And this is global accessibility. So that's what I wanted to check is it only Australian stocks? Or is it global stocks? So basically, our fund is the first charity plan ETF in Australia. Yep, blah, blah, blah. What I care about is, so basically, essentially, this is one that is to access stocks, which is considered growth assets. So let's go back and have a look at. So that's what this one is. So the next one, HJZP. So this is real estate. So real estate, specifically land, is the oldest form of investment. It has proven to be a reliable store of wealth. So this is what this ETF is about. So they have pooled, or the pool of money that's there and you can add to is buying real estate, especially land, because it's seen as, this is something that's definitely considered more stable than companies. Sukuks, I mentioned that. I can already guess what this is. This is essentially Sharia compliant bonds or halal bonds. So this is going to be not as high of a return as the companies, but this is more stable. So it'll be a smaller return, but you can generally expect that same return every year. Whereas with companies or stocks, it might be 10% up one year, might be 5%, it might be negative 3% one year. So it's very up and down. So yeah, that's just something to be aware about. So then we have HHIF. So this ETF includes innovation-centric companies, disruptive trends. So this, if you just compare this one, just general ordinary companies with innovative companies, you can already guess this has a higher growth potential, but a higher risk because their innovative ideas may not work out. So yeah. And then last one that they offer is this one, which is this ETF offers investors the potential for regular dividends. It is particularly appealing to income-focused investors. That's actually really cool. I did not know that. I think this must be new. So in the previous video, I discussed what dividends are. It's basically a share of a company's profits. So this is an ETF where you want to make the most when it comes to getting passive income that typically is obviously relating to companies typically. So that is one of the, I guess, companies or organizations that now offer halal investing options. I believe they also offer superannuation, so where it then invests in these same things. But when you understand the concept of investing, you can invest your surplus money, your savings into this to grow it in a halal way. So that is one of the companies, is Hejaz. So next is another company that I want to highlight. Give me a moment. That's more for America. I did contact them, and unfortunately they don't offer at the time anything for Australia, although that might have changed. Okay, so this is another quite starting to grow in popularity company called Wahid, especially because these guys, Mufti Meg and Habib, they are promoters of it. So they offer different funds as well. So I thought they had more than that, but I could be wrong. But they offer, so actually I'm going to show you in a moment, if you just look up on a just general investing comparison website, like MSN Money, Yahoo Finance, etc. You can search and get more information about these funds. So yeah, essentially, what's the difference between Wahid and Hejaz? They're just an American company, from what I am aware. And so the good thing though is you can actually access Wahid through Stake. So that's why I wanted to highlight them as well, if you want to tap into that US market to spread your risk for the potential of growth. But it's the same kind of concept in the sense of, if I just go back to here, they have funds where, let's just have a look at their two funds. But they have funds where, it'll be stocks, but then they'll also have funds where it'll be property, et cetera, et cetera. But they filtered out the things that are not aligning with Islamic values, as well as high debt, et cetera, as we just earlier. So I think I'm going to actually just go to like MSN Money, makes it, I think it's a bit better. Okay, so this is an example of just a normal site when you're trying to find investments. So basically you can do a search. So I'm just going to search Wahid. So this is an example of one of Wahid's ETFs. There is the USA Sharia ETF. It's called Halal. So it gives you an idea of what the current price is. So basically it's saying to get one share or one stock in this ETF, it costs $51.82 US. So yeah, potentially you may be able to invest with even less than 500 Australian dollars, but in the US market through Stake. But this gives you an idea about the up and down nature of investing. So if I go maximum, that's the most important thing. And this is why people who have had a bit of experience with investing, they're comfortable with the up and down. Because if you look at this particular stock, since 2019, it used to cost $25 a share, and now it costs $51 a share. So in other words, it's actually double. However, in this period, there was actually a period where it was 25, and then in the next year, it was $21. So if you panicked and you sold, that's where you lose money. So that actually brings me to an important concept that I want to highlight when it comes to investing that I guess newer investors aren't aware about. And it is this statement I want you to be, I guess, I'm going to write it down. So go back to my notes. You haven't lost your money until you sell at a lower price. So what do I mean by this? Let's go back to that website. So I bought let's just go super basic. I bought, one share in Halal. Cost me $25 in 2019. And then I noticed, oh my God, it's going down. And I noticed in March 2020, it's now only worth $21. And I'm like panicked. I'm like, oh my God, it's going to get worse. So I sell that one stock and I keep $21.61. However, if I didn't sell and I reminded myself, based on what I learned in this video and other videos and other investors, that's investing. It's going to go up and down, doesn't always make sense. Sometimes it's just crazy news that doesn't actually really affect the company in reality when it comes to their, just how good they are. So I'm just going to ignore it, pretend nothing is happening, and then I'm going to check the following year. So I'm going to check around the same time the following year, March. Whoa, it's now $35. If I had sold, I would have lost, about $5-ish. But I didn't panic. I didn't sell. This is a very lower risk investment in the sense of it's not one company I've chucked all my money in. It is pretty much, it is the FTSE, that whole market minus the shares that are not aligned with Islamic values. So it's like hundreds and hundreds of companies. If we actually look at it, it'll tell you. So it is, the FTSE in the USA. It even lists some examples of holdings that is in there. But yeah, you can learn more about it in a website like MSN Money. But I just, held on. So now around this, a year later, in the following year, it's now worth $35. I've actually made, almost $10 just by holding that. And then this is a long-term investment, not going to sell, just going to leave it. So there's a time where it goes back down. It's 33. Now it's a bit higher, 40. But current day, it's doing pretty good. It's over 50. So that kind of gives you an idea of what is involved when it comes to investing. But a key principle with investing is you haven't lost money until you sell at a lower price of what you bought it for. But why would you sell at a lower price that you bought it for? If this makes probably more sense if it's a particular stock. If there's maybe news that, the industry is changing and maybe these sorts of companies aren't going to exist anymore, I'm not going to, I'll lose money, but I'd rather keep 50% of my money than have zero because the company, files for bankruptcy. So that would be an example of when you would sell. And that's why, just unless you really study the company, I certainly don't recommend investing directly in individual companies if you're just a beginner. Do a course, really learn about it, but otherwise stick to an ETF where they have experts doing the hard work for you. They are analyzing the company. So if the company's debt becomes too high and it doesn't follow Islamic principles anymore, they remove it from this pool of from their list. And you don't have to do anything. You just put money in there and the experts are actually looking after the money who look after this ETF. So yeah, so that's an example of another company is Wahid. So I mentioned Hejaz. So if I look up Hejaz, let's go back here. Hejaz. If I look at all of those ones that we mentioned pop up, so let's have a look at, say, Sukuk. So the only thing about Hejaz is they are newer. So you'll see it's up and down because as in they're newer in the Australian stock market. So although the investment option has been around probably a way longer, it's only new in the Australian stock market. So you actually don't get a lot of history as compared to Wahid, which has been around obviously since 2019. So that's the only thing. So yeah, I would say don't be too concerned about the history. You want to look at, I guess, Hejaz, the company itself, when it comes to this, because there's just not enough data for us to be able to see it. I would rather look at, just the concept of it. What is the concept? It's a more stable investment. They're halal bonds, essentially. And it even tells you a recommendation of how long you would typically want to keep your money in there, etc., etc. So that is how you can look at this. So personally, I really like MSN Money just because just how it's kind of laid out. You can get tons of information about it, related news, all in the one place. So yeah, but there are others, like Bloomberg is another popular one where you can get financial information. So let's just have a quick look at my notes. Okay, so there's two more. So I mentioned Hejaz and I mentioned Wahid. So if I look up Wahid again, so if I just type Wahid, it actually shows me, actually those two. But there's actually two more that I've come across that I want to highlight of other halal funds. And one is this one, SPUS. So this is invested in the S&P 500, but the Sharia compliant ones. This has been around like even longer. So actually, only since 2019. I don't think that's right. I feel like it's been around longer than that. But yeah, same idea. So what is it? It is seeking to track the performance of the S&P 500, but Sharia Industry Exclusions Index. It's composed of constituents from the sub-industries, aerospace, defense, financial exchanges, etc. So this is where you can learn a little bit more about what that company, what sort of things it's invested in. So it gives you an example of companies. So you'll see an overlap, of course, as the other one, which is Wahid. So you can put some money in here, but then you can also decide to just stick to Wahid, but just gives you a bit of an idea about what's available to start to consider those decisions. So the last one that I have come across, and by the way, but you can access this also through Stake, is SPRE, and this is the London Stock Exchange. Is this the right one? No, I don't think that's right. SPRE. Where are we? Indonesia. Okay, this is the right one. So SPRE, so this is the US stock exchange, and this is focused on global real estate, REIT. Remember we talked about REIT. So again, just like another fund that you can consider putting money into if you want to be invested not just in like Australia. These are like some US ones. So let's just go back to the notes. So how do we bring this all together? So essentially, let's do a wrap up with an example. I'm just going to go just after here. So we've talked about, let's say this is my portfolio that I'm aiming for, which is 60% growth, 40% defensive. So let's say I'm just going to keep it simple and stick to Hejaz. So Hejaz has, let's see the examples again. So they have Islam, which is stocks. And then they have HJZP, which is property. And then they've got another one, which is also relating to companies, but it's innovative companies. Let's just put those. I'll put this one together. innovative companies. And then we'll do one more, which is Sukuk, which is the halal bonds. I think there is another one as well, but we won't worry about the other one. Let's just keep it simple. So we've got Sukuk, which is halal bonds. So looking at this, which ones are considered growth? You should know the answer. It's Islam, HHIF, and property. And which is considered defensive? Obviously, it is Sukuk. So essentially, if I have $1,000, the way I want to split this is the easy one is Sukuk. I know I'm meant to put 40% there. So 40%, that means $400. $400 goes to Sukuk. But then I've got 600 to work with. So let's say I might just go, how many do I have to split it between? So I've got property. So let's say I actually really like property because I just feel like property is just more stable. I've never really invested in companies before. I'm a little bit more nervous about that. So I might want to put more of what's left over in property. So I might go, you know what, I'm going to go, let's say 300 in property. 300 in the property one, which is this one. And then let's see, what else have I got? So then what am I left with? I've just got two company ones. One is just sort of standard shares, one's a bit more innovative. So let's say, because there's not a lot left, because I basically have, I'm going to go evenly between the two. So I'm going to go 150 in just the normal stocks, and then 150 in the more innovative companies. So this is how I use my risk profile to make decisions on how I invest and split my money. And like I said, there's something called rebalancing. So I'm just going to flag it so you can, do a bit of research on your own. Rebalancing portfolio. So this is something your superannuation fund would do. This is what a financial advisor, person managing your funds would do. But there's something, I'm just going to flag it. I might discuss it in another video, but there is something called rebalancing portfolio, which is where you essentially are keeping the percentage breakdown the same. But yeah, that's like for a whole other discussion. But yeah, that otherwise brings me to the end of our introduction. So how did we go? Wow, an hour. Makes me think that's probably why my previous video, dropped out halfway through. It would have been an hour and 40 minutes of content if I had done all of this in one go. So anyway, I hope you found this useful. If you are aware of any other halal, ETFs or funds, feel free to mention them in comments. I say that with some trepidation in that also be aware of obviously scammers, be very, very careful. But I'm obviously mentioned the ones that I have done research about and I'm definitely more confident in. But once again, I'm not a financial advisor. Please don't take anything I've said as financial advice. Just take it as just edutainment, entertainment, but use this rather to feel more and be more empowered when it comes to financial knowledge. So when you do talk to a financial advisor, you go in not completely blind, but you go in with some basic concepts that will help you ascertain, is this person taking me for a ride, or do they actually have my best interest at heart? And they actually are, wanting me to, grow my wealth, but also protect my wealth for the sake of, my family and my future generations. But yeah, thank you for listening. And yeah, feel free to share it with others. And don't forget to like and subscribe.